Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Hope everyone is having a good day. As always, give me a thumbs up if you can hear and see me, or at least hear me, so we can get this party started. Is it a party? I don't know. That might be trying a bit too hard. Oh, thanks, David. Got a thumbs up. Okay. I'm going to ask a question of you guys, and then I'm going to do my little monologue, whatever it's called, and then we'll go back to the question. But the question is, in retirement, do you do? I was an English major. That doesn't sound right. In retirement, do you do volunteer work? That's the question. Just yes or no. If you're not retired yet, but you plan to do volunteer work, you can answer it too. So anyway, I'm not going to try to wordsmith that terrible question. Oh, look at all the thumbs up I got. Wow. David, Paul, Kyle, Daniel, Keith, Mark, Wolfster. Vinyl is in the house. I pulled Vinyl over from another YouTube tab, so that who knows what he was watching. Okay, so the sort of question of the week or of the show that I wanted to touch on is this question. You can ask it a couple of different ways. The way I phrased it was how to invest when stocks are expensive. Maybe another way to think about that is, should we consider valuations in our investment decisions? And so the interesting thing to me about that question is, I do invest in a few individual stocks, not a whole lot. But in the case of an individual stock, that's my primary consideration. Is the company at least fairly valued? I do my best to answer that question. If you follow Warren Buffett and his work, he's a value investor, or at least, again, not overpaying for an investment. And you might have a great company, but if you pay far above its intrinsic value, you're not really getting a great deal there. But when it comes to mutual funds, in ETFs, sort of the buy and hold index fund, 3-fund portfolio, whatever you've got, I don't give a second thought to valuation. If we make a IRA or 401k contribution or whatever, I just put it in and add it to whatever fund I need to in terms of maintaining my asset allocation. I don't think about it in terms of the valuation of, say, the S&P 500. So how could we think about it? And the reason I decided to make it the topic today, first, because stocks are still pretty richly valued. We can use the Shiller PE. It's a sort of a normalized, cyclically adjusted PE. So you got the price and the earnings, right? It's a ratio between price over earnings. The price we know of an index or an ETF or a stock, but in terms of earnings, what do we use? So some will use sort of an estimate of the earnings expected over the next 12 months. Some use the trailing 12 months earnings. Well, what the Shiller PE does, and here it is, it goes back over 10 years. Adjusts the earnings for inflation and uses that. And the theory behind it is you get earnings over a whole economic cycle, a recession, you have growth and so forth. And as you can see right now, we're at 34. We're not at the all-time high, but boy, we had the peak here, the tech bubble, and then we had this peak here, I guess, after COVID or towards the end of, I don't know, when did COVID end? Has it ended? Maybe it hasn't ended. I don't know. But we're still really high. We come down here, the mean and the median, 16 to 17. So, we're pretty richly valued right now, right? It's one way to look at it. And so how could we use that? Well, and I've gotten a number of emails from folks on this question. One would be if you've got the sort of lump sum versus dollar cost averaging question, because you've got a bonus or an inheritance or whatever. Or you're rolling over a 401k, which is kind of interesting to me. I get these emails a lot. People are rolling over a 401k and they had it invested in whatever. And they, it was taken to cash, moved to an IRA, and now they're kind of scared to reinvest it. And I'm always like, well, yesterday you had it invested. Why not just do what you did yesterday, but inside an IRA? But in any event, dollar cost averaging versus lump sum. And the theory is, or the question is, Rob, I know your views on that, and lump sum normally wins, but not always. But what about when stocks are richly valued? It's a good question. That's one way it comes into play. Another question I get is, should I change my stock bond allocation? Maybe you're 90-10, but you're a little nervous about stocks. Should I make it 80-20 or 70-30? And then the third way, and this is the way that might resonate with me, and that is not to change your stock bond allocation per se, but within the stock allocation, maybe change up your asset classes. So today, for example, you might say, I'm going to move even more to international, maybe even to emerging markets, because on a valuation basis, they're cheaper than US stocks. And we can look at that. I can just show you what I mean. Let's see here. We'll go to Morningstar. So if we go to, we'll just use VU. That's S&P's, Vanguard's S&P 500. And I need to be a little careful here because Morningstar often uses a normalized version of PE, which I'm not always fond of. Not the Shiller one I just showed you, but whoops, wrong tab, portfolio tab. The PE is 20. So I think that's roughly right. The thing is, we can actually go, let's go to Yahoo Finance. I can't spell Yahoo. I don't normally use this one on the show, but I don't know why not. It's perfectly fine. If we go to VTI here, are they showing the same PE? Oh, they're actually a little higher, but still, either way, 20 on Morningstar. Yahoo uses trailing 12 months, which is what is my preference. They're 23.89, but let's go to, let's see if they give me the PE of a mutual fund. I could use the ETF version. They don't. Hang on for a second. ETF version of VMAX. I don't know the ticker. I guess I could have just looked it up. Oh, that's right, VWO. I should have remembered that. So VWO is a Vanguard Emerging Market Fund. I've owned it in the past. I don't own it now. Look at the PE, 11. I don't know how well you can see it, but on a trailing 12-month basis, S&P 500 is 23. And just as an example, emerging markets is 11. And so one theory would be, okay, we're going to keep our stock bond allocation, whatever it is, but we'll move more into international, maybe more specifically into emerging markets, which is sort of a subclass of international, right? Or maybe small cap value, because it's also cheaper, less expensive. If you, at least based on a sort of PE analysis, you could use other valuation metrics, but I think they'd all show that something like an S&P 500 is more expensive. And so why not do that? And by and large, I don't do that. And there's a couple of reasons for it. One is a timing question, because just because something's expensive doesn't mean it's going to go down in price anytime soon. And just because something's cheap, relatively speaking, doesn't mean it's going to go up anytime soon. And so you can find yourself having made some significant change to your portfolio only to watch it underperform. And so there's this sort of psychological component to that. And I'll show you what I mean. If we go back to the Shiller PE, I mean, it's been above the average. I mean, it dipped here. This is the financial crisis, right? But ever since then, I mean, that was 15 years ago. Ever since then, it's been well above, the median and the mean. And so, maybe we could have made a change all the way back whenever, 13, 14, 15, and missed out on pretty significant growth. But there's another problem in my mind, and I'll be curious what you guys think here in the chat. But as you start to make these changes, even if they work out, however we define that, you're then left with the question, well, when do I go back to what I had? Now, I suppose one could say, well, Rob, we'll just use valuations again. And if you move 10 or 20% into emerging markets, just as an example, when they become expensive and S&P 500 is cheap or whatever, you'll just move it around again. And I just don't have confidence that most people, myself included, can really do that in a way that's going to be productive, tax efficient if we're in a taxable account, and that's going to, at the end of the day, give me better returns than just sticking to what I've got. The other thing I'd point out, in the newsletter last week, I had an article. I'll show it to you. I included an article I think it was last week's newsletter. It's funny, after I send the newsletter out, it's like I almost forget what's in there. But I also added it to my site. But there was an interesting fact, and the reason I added it to my site is this one. What if you invested at the peak right before the 2008 crisis? Ben Carlson wrote it. Uh, Here's his actual site. And he pointed out if you invested at the peak of the market right before the 2007 to 9 crash, your total return through now is 345%, which comes out to about, you probably can't read it, but 9.5% a year. Now, this is obviously just one example, but the point he was making, I think, is that we shouldn't get, we can't predict. There's no way we can predict, even if the market's high, that's going to go down tomorrow or this month or this year. And even if we get extraordinarily unlucky, long term we'll be okay. And so at the end of the day, people have emailed me a lot. Now I'll just send them to the first part of this live Q&A. It's just not something that I personally think I can do successfully. I think it adds a lot of mental and sort of psychological overhead to what's already a difficult thing to do, and that is, invest and buy and hold. So for me, it's just not something that I can't say under no circumstance would I ever do it, but it's certainly not going to be a main part of my approach to investing. All right. Enough of that. Let's get to the good stuff. First of all, let's check out the poll. So 56% of you say you in retirement, you volunteer or you plan to. I'm curious if you've put in I'd love to hear in the chat now what you're doing, to the extent you care to share, how you're volunteering, maybe where, or you don't have to get specific if you don't want to, just sort of generally. I got an email from a viewer that kind of wanted to know, she's trying to figure out what she's going to do, and maybe you can help her out, give her some good ideas. I don't do any volunteer work. I don't know that it's not that I won't. We tend to contribute, or we do contribute to a number of charities, and to me that's very important. Particularly charities that help children is sort of our focus. But at the moment, we have in the past, particularly my wife. I guess I'm not a volunteer kind of person, but I don't rule it out. Life just seems so busy right now. It's like I don't know that I'd have time. I don't know where I'd find the time. Okay. Well, while you're answering that, here's Mike. Meals on Wheels. That's a good one. It's a very good one. Here's one. Boggy. Gotta love that name. Driving people to medical appointments. That is so important. Because a lot of people just don't have folks that can help them. Here's a good one. Noreen, when she retires, she wants to raise another guide dog. Thank you for being here, by the way, Noreen. She runs the show here. What else are people doing? One thing to me, it seems, too, about volunteering is there could be in retirement, a really important social aspect to it. This is interesting. This person's working on AI safety in retirement. I wonder what that looks like. What else are people doing? I'll get to the other questions here. I just want to see. This is actually a question. CH, do you subscribe to having an allocation to small value, such as VBR? For a long, long time, I had small cap value. I have a little bit right now. I always have small cap value, right? Because I'm always in sort of a total U.S. stock fund. So the question really is, do I over allocate to small cap value? Today, not so much, but for a long time I did. I don't think it's a bad option, but sometimes it doesn't work. It hasn't worked recently, last 10 or 15 years. But you go back further, it worked wonderfully. Whether it'll work in the future, don't know. All right. Let's see here. I want to go back to the top. So I can't put the first few on the screen, as you already know. But This one's from Paul. He says, in your 525 newsletter, you link to a Morningstar article about 2 new actively managed bond funds and a mutual fund counterpart. Would there be any reason or advantages to swapping out BND to one of these ETFs for someone in early retirement? There's really, the short answer is I have no idea, but I find it hard to believe there would be a significant advantage. Now, I will tell you, I've not studied those funds in detail. They're new, so there's not a lot of history. I mean, we know from the research that SP Global does, and I did a video on this just the other day, that even in the fixed income space, it's hard for actively managed funds to outperform an index fund. In some subclasses of fixed income, they have better luck than others, but it's still not greater than 50% outperforming. And many of them, it's 80 or 90% underperform. Whether these specifically will do better, and then you have to think, well, how much better will they actually do, and how much will it really matter? Particularly depending on how much you have allocated to these funds. If you're in early retirement, I'm going to assume that you still have a heavy weight to stocks, but yeah, that's my best guess. And then Susan won another bond question. For bond fund allocation for a portion of fixed income, is there any advantage to a 50-50 BND VGIT or BNDX? So let's talk about those. So we'll look up, we know BND, that's just a total, basically US bond fund. It doesn't include TIPS, but government bonds, some corporate and some agency, sort of like mortgage-backed securities. VGIT is the Treasury, I'm pretty sure is the Treasury fund. VGIT, yeah, intermediate term Treasury. I really like this fund. I don't own it. I own BND. But there have been days when I've thought I should just switch to this fund. I like this fund a lot. But at the end of the day, is it going to make some dramatic difference to me and my family and our retirement? That choice between BND on the one hand and VGIT on the other? Probably not. And then BNDX is the international. I tend to not invest in international bonds, but I don't think it's a bad approach to put some of it in a fund like BNDX. I can tell you that Vanguard's target date funds and their life strategy funds use this. They have some allocation to international bonds, so I certainly don't think it's some mistake at all. I've never convinced myself that it's necessary. So, and maybe I'm just not thinking hard enough. Maybe it is necessary, and I don't know what I'm talking about, which should probably be our going in assumption here. All right. I got another question for you guys, and then another poll. And you have to be honest here. The question is, have you bought Bitcoin for the first time? So you never owned it before, but you bought Bitcoin for the first time this year. Just curious, since it's gone sky high. What's Bitcoin? What's the price now? Like $250 trillion per coin? Bitcoin, I can't type. Bitcoin price, 72,000. So I told you, like in October, I think it was, I thought to myself, I should invest in Bitcoin on the theory that it's going to go up in price because the whole halving thing, which I don't even understand really. And the whole, it'll be approved by the SEC for ETFs, and people are just going to flock to it, and I'll hold it for 3 or 4 months and then just sell. I didn't do that. I should have. Actually, probably not. The problem with doing that and being successful, you say, well, what's wrong with that, Rob? I mean, even if you don't believe in Bitcoin as an investment, but you hold it for 3 or 4 months, you 2 or 3 or 4 extra money. It's because I would walk away with that thing and, hey, I can do this when I can't. I just got lucky, but I didn't even buy it. I probably would have actually bought it in the form of MicroStrategies stock, a company that I have absolutely no interest in owning whatsoever. But it would be the easy way to own it in a Roth IRA, right? Because they've basically turned their software company into a Bitcoin ETF. Ridiculous. All right. enough of that. Boy, this seems like an SAT question from Raj. I don't know. Out of 4 criteria, turnover, interest paid, capital gains, and dividend, which one would save money in taxes by investing in IRA ETF? Well, okay. First of all, I have to make sure that IRA is not a ticker for an ETF, and you mean a retirement account, right? Well, turnover. Let's just okay. I'm assuming the question is investing in some kind of ETF in an IRA retirement account. At least that's how I'm interpreting this. Turnover deals with how much they're buying and selling each year, right? Now that can trigger capital gains, not necessarily. Depends on other factors. They may have some losses that can offset the gains with. But of course, in an IRA, that doesn't matter to you. Neither does capital gains or dividends, at least from a tax perspective, right? Because it's inside a retirement account, so there's no taxes for that. But it could matter. The higher the turnover, they have to pay for those. They're paying transaction fees, and those get passed down to you and me, and they're not part of the expense ratio. So if there was significant turnover, it could generate fees, and I'd also be a little concerned about the strategy. In an index fund, you really don't, at least all the ones I've looked at, turnover is very small. I'm not sure what you mean by interest paid. Maybe that just means dividends for stocks and interest for bonds. And again, inside an IRA, none of that really matters if I'm understanding your question. Vinyl wants to know if volunteering includes unpaid political office. Yeah, I guess so. I don't know why not. Sure. I mean, not that I'm the person who defines what volunteer work means. Okay, what's next? Oh, I wanted to show you something real quick. So I showed you this article on my site. It looks like this, by the way, because I went here and just grabbed it, a PDF of it, and there's like an ad in the middle of it. But I have a summary that I wrote up, a 1-sentence summary, some key quotes, and the charts. There's a few charts. But I thought just, I don't know, you might be interested in this. How do I do that? How do I get all that information into a WordPress site? I start with this application, which is Zotero, Zotero. It's free. Academics use this. Like if you were going to write you're getting your PhD and you had to track all your research, you'd keep it in. You could keep it in Zotero. Again, it's open source, free software, and so I can bring a PDF in and open it up here. Here's what the PDF looks like in Zotero. I can highlight it. I can even, as you can see, that yellow box around the chart, and it brings it over into all these notes. And then I can create an annotation out of it, which is all of this, right? And then there's a plugin, but I can automatically bring it into, let's see here, Zotero. I'm not Zotero, Obsidian, which is a note-taking app. And I can add some information here. I can link to other parts of the Obsidian Vault that I have. It brings in all the images. And then it's a bit of, at that point, it's a bit of cut and paste into WordPress. But the colors are important. The green are what end up here as key quotes. It's just a quick take on what I think of usually the significant findings of the paper. I've got, hundreds. I mean, I haven't even scratched the surface. I got so much work ahead of me. It's not even funny. All right. So Isabel says, I have cash in a Roth IRA and a few stock and S&P 500 fund. Which funds do you think are good funds for a Roth? So any fund would be fine in a Roth. So for example, if that's the only kind of account you have and you wanted some kind of allocation, you could put stock funds, bond funds in a Roth. Yeah. If But if you have multiple types of accounts, like you have a taxable account, a Roth, maybe traditional, what I like to put in Roth accounts are the funds that have an expectation of growing the most, which would be stock funds. Because since a Roth is tax free, assuming we follow all the rules, I want that to get I like to say as fat as a tick, which is I learned that saying from my mom. I learned most of the funny things from my mom. She has, yeah, I don't know if her upbringing, what happened, but she has a lot. She just uncorks them out of nowhere. Like, where in the world did you get that from? Anyway, that's my answer, Isabel. Hope that helps. All right. Here's another good one. Mike coaches Special Olympics. That's terrific. All right. Let's see how the poll's going. Curious. So most of you did not, at least you might own Bitcoin, but it wasn't your first time. 3% said yes. So here's the question for the 3%. You've probably made money. How do you know when to sell? That, I don't know. I don't have an answer to that myself. That's one of the reasons I don't invest in it. Or gold. I wouldn't know when to sell. Maybe you say you never sell, but they don't do anything. I don't know. Maybe I'm just not smart enough to understand the future about, I don't know. Just don't make no sense to me. So Wolfster wants to know, if you roll a Roth 401k into a Roth IRA, does it trigger the 5-year rule? So I always try to preface these sorts of questions with, you should assume I'm wrong because I don't know what I'm talking about. So there are two five-year rules for a Roth IRA, right? One is you have to have an account open 5 years. That's the first 5-year rule, and it applies to the first Roth IRA you open. And once you meet that rule, you meet it for all. You could open up 30 other Roth IRAs. You meet that rule for all of them. You meet it once, and it's one and done. And so that rule, I'm pretty sure, would apply if it's your first Roth IRA. And your age doesn't matter, right? It's not like, well, once you get to 59 and a half, you don't have to worry about it. If you open up your first Roth IRA at 72, you got to satisfy that 5-year rule. Now, if you don't satisfy it, what happens depends on a lot of other things. Because remember, but I think you're probably talking about the 5-year rule on Roth IRA conversions. And this is not a conversion. A conversion would be traditional IRA to a Roth IRA, among other things, right? So my hunch is it doesn't apply, but if I'm wrong, trust me, the chat will let me know. I could look it up, but I'll let you do that. You could Google it, or just ask your Roth IRA provider or the administrator of your 401k, just to make sure you get it right. You don't want to get it wrong. Let's see here. What's next? By the way, if you want to ask me a question or have me cover a topic, put @RobBurger in it. We already got our first chess question. What is your favorite opening? Well, that would depend on whether I'm playing the white pieces or the black pieces. For white, I really prefer E4 openings. As to what my opponent plays, I don't know that I have a strong opinion. I mean, yeah, but I play E4. And then, of course, what I play after that depends on what my opponent does. As black, I tend to play E5 against E4, and I play what's called the Semislav against D4, which, and if you're not a chess player, none of this is making any sense, but again, it just depends on what they play. I like tactical chess. So I love it when I'm black and white tries a gambit, like the King's Gambit, for example, because pieces are usually everywhere and it's a mess. Okay, Joseph says, keep in mind I'm still a novice. Convince my daughter, who's 25, to open a Roth. I guess she's a teacher. Better to go with VU, knowing it will be longer to buy stocks, or cheaper like VDIGX. I don't know what let's figure out what VDIGX is. This is always good. So like, if you're new to all this, we can go to Morningstar and we can go through this. We'll look at V. So just type in the ticker. Oh, the Vanguard Dividend Growth. And so how would you think about these two funds? They're both good funds, but how would you think about them? So they're going to be very similar. We can look at VU. My guess is, see this blue dot? What's that telling us? We got this grid, right? So in this top row, you can see it says large here. If the blue dot is somewhere in this top row, it means that on average, the companies in this fund are big companies as measured by the value, the outstanding shares of the company times their price. So think Apple and Microsoft and the like. Of course, it could be anywhere in this row. The higher up it is, the larger. In fact, sometimes you'll see the blue dot outside of this grid, up in here. And then as it moves left and right, to the right, it's growth. To the left, it's value. And in the middle, that BLD just stands for blend. And all growth means is a company is growing its revenue and earnings faster than average, is measured by, price to earnings, price to book. And value means it's not growing as fast, but they tend to be less expensive. If you think about the cost of a stock, the cost of any investment, at least an investment that actually earns something. You can think about it this way: for every dollar, what's it going to cost me to invest in something and measure it based on the earnings that the company or the thing? It could be a real estate investment. You're going to buy a home or a condo and rent it out. Well, how much am I going to earn, and what's my cost going to be? What money do I have to put in to over time get those earnings back? So anyway, and we can see this one's a blend. I think if we look at VU, it's going to be a little further to the right, I'm guessing. We can go to VU now. Go to portfolio. Yeah, it's a little bit more towards growth, not a massive difference. But because of that, it will have outperformed, I'm going to guess, over the last 15 years. We can compare it here, VDIGX. Can we compare? Yeah. So the dividend is red, and you can see at least this is 1 month. Let's start at 5 years. So at least right now, VU is outperforming, but here it was underperforming. Right. And if we go to max here probably won't work. Yeah. You can ignore the max because they don't line up the time periods. Like the VDIGX hasn't existed as long. So what we can do, let's just go, we'll just do 93. So let's go here and we'll do, we can set the date ourselves. Let's do 93. Let's see if this works a little better. Yeah. So it's underperformed significantly, but also value generally, and it's more towards value, is really a blend, has underperformed the last 10 or 15 years. So where does that leave us? My personal preference is just to stick with the stock market as a whole. Now, one could argue what you really want is VTI, which encompasses pretty much all U.S. companies, but we know that VTI and VU, they're very similar in terms of performance. So at the end of the day, I don't think either fund is a bad fund. I mean, they're obviously, but they're both reasonable. I personally would like something that's more covering the whole market. That's just my approach. Whew. Okay. David's watching. It's 1 a.m. Well, it's 7:34 here, and I guess it is dark out now. It was light. I still haven't gotten adjusted to new time. All right. What do we got next? Oh, let's see. Hang on, just checking something. Still at 4% on having bought Bitcoin the first time this year. I'll end the poll. Hamid wants to know, what would you say to a person who doesn't have a 401k, but they're maxing out their, I assume, Roth IRA? Well, keep doing that. Save in a taxable account. Talk to your employer about getting a 401k. It's not the end of the world not to have a 401k, but, particularly if you can get one where there's an employer match, boy, it makes a huge difference. And, you hate to have that be a major factor in where you're going to work, but probably is a factor. But just you got to work with what you got, right? And if you don't have a 401k, you just take advantage of what else you can do, in the Roth IRA or traditional, depending on your circumstances, are good options. You might have an HSA, and you could use that you could think of that as additional retirement savings. Would be another option too. Okay. Stephen points out that if you're timing the market, you've got to be right twice. Well, that's twice on each round trip, right? And then you got to do it over and over and over again. I think if you're doing it based on valuation, one could argue it's not exactly market timing, but it does feel that way. I know, but still, you still gotta get it right. However you want to, whatever you want to call it. Yeah, I have no confidence in my ability to do that. All right. Let's see here. This looks like a complicated question. For an early retiree that needs to live off taxable accounts for 10 to 15 years, leaning toward building muni bonds to allow for more Roth conversion, lower return rate may help with ACA. Thoughts? That's a complicated question. So if I understand it, you're going to retire early. You're going to live off of taxable accounts, I guess, till you get to 59 and a half, presumably. Of course, you could tap retirement accounts sooner. There are ways to do it, but in any event, so you want to do Roth conversions, but lower return rate. So meaning municipal bonds have a lower return rate than regular bonds, than stocks. I mean, the yields are lower because of the tax advantages, right? You want to do but here, I guess I'm a little confused, because if you're going to do Roth conversions, of course, that's going to come from let's assume a traditional IRA. And so you want to keep your income down to a level where you can still get ACA credits. All right. So that's going to dictate in part how much you convert. But it sounds like what you're saying is you don't want investments in your taxable account that throw off a lot of interest. In this case, I guess you could have stocks that throw off dividends, but you haven't mentioned that throw off a lot of interest, because that's going to eat up some of your taxes as well. It's going to be part of your taxable income. Although with a muni, of course, you're not going to have federal. You may or may not have state, depending on where you live and the municipal bonds. Yeah, I mean, I guess that could be an approach. I guess the bigger question for me, though, is, apart from taxes, as important as they are, and ACA credits, is an investment in municipal bonds the right thing for you? And how much of your taxable account is going to have to go into municipal bonds to achieve the tax outcome that you want? And if you find yourself putting a lot more in muni bonds than you otherwise would just to get a specific tax outcome, that I would have pause on that. It at least would be a question. What would your taxable accounts look like if you didn't have to worry about the ACA and the Roth conversions? Would you still be putting all this money in a municipal bond fund, let's say, or muni bonds, if you're investing in individual bonds? Those would be questions. And then I guess part of it too would be, how much money are we talking about in terms of the ACA credits? Is it talking about maybe just losing some of those credits, all of those credits? Could you, do you have stocks in your taxable account? And what does that investment look like? And are they throwing off dividends, which could have an effect? That's a tricky question, though. There's just so many moving parts. I'm not sure what else I could possibly say that would help you. Whew, you guys, these are tough questions. I like the chess question best. All right. Looking for more. Remember to put my name if you have a question for me. Here's another volunteer, Sarah, mentoring low-income single mothers who are in a nursing program. That's fantastic. Rob Harris volunteers in the Neighborhood Association and local parks. Can you give an update on your credit card rewards? I can. So I stopped taking all the rewards and putting them into it. So I had them in different accounts. Like at one point I tested out the Vanguard. Well, let me back up for people that don't have any context here. A couple of years ago, I decided to start investing all of our credit card rewards. So, I'd cash them out and I'd put them, at first I put them in bank stocks. Then I put them in, I wanted to try out Vanguard's digital advisory service. So I put them over there. Then I moved it all over to Betterment and had it there. And then I pulled it out of Betterment, and I've not really kept up with it. I could recreate it, meaning I could go back and look at all my records and recreate it. And in fact, let's do a poll. Should I do that? Should I start tracking credit card rewards again? I'm going to yes, no, and I don't care. But the idea was I wanted to show, one, it gave me an opportunity to try out these different services and share my thoughts on them. But it also allowed me to say, hey, look, investing relatively small amounts of money over time actually makes a difference. And I think the account got up to like 40 grand at one point. And actually it would be higher than that today. I could go back and look at it. I mean, what I did was when I took it out of Betterment, I just mixed it into our accounts, but I could figure out what it would be. But I don't know. I wasn't convinced that I hadn't convinced myself how useful it was. But back then, what I would do every now and again is do a video that says, here's the status and whatnot. My actual strategy hasn't changed. I use a Bank of America, I think it's Premier Rewards. You get, depending on if you have extra money at Bank of America or Merrill Edge, you get additional rewards. So like I get a minimum of I think it's 2.63 or 62% on all purchases. More if it's I think a restaurants. We use the Amazon Prime card for Amazon and Whole Foods. Those are probably our two primary cards. And then I have business credit cards that generate a lot of cashback rewards. And so the amount of money, I mean, it adds up and it's pretty significant. And so, yeah, I don't know. 44% say I don't care. I get it. 42% say yes. That's a pretty significant number. 13% say no. For the love of God, Rob, don't do it. I'll leave the poll up for a little bit longer. But I don't have a dollar amount that I can tell you it's worth X now. I'd have to go back and recalculate it. And then I'd have to figure out how part of it is how can I segregate it from my other investments so that I can keep a track of it, which is not, I mean, I could do that. It's not that hard, but we'll see. It's neck and neck between yes and I don't care. So I'm going to leave it running for a bit and I'm just going to do whatever you guys tell me. It's like Elon Musk on Twitter. I'll let you guys decide. Here's someone that volunteers at stray animal adoption program, transporting animals from shelters to vet. Oh, that's good. Then to foster for adoption. Lovely. This is a great question. This used to worry me. By the way, I'll show you while I'm answering this question, I'm going to show you what I see on my screen on the left here while I'm taking a poll right here. The I don't care is winning 44%. So that's not looking good for the yeses. Anyway, I used to be concerned about this like years ago that you have all these folks retiring and they're going to take all their money out and prices are going to crash. But yeah, that's just really not how it works. I mean, demographics can absolutely affect a market for sure. And it's an interesting dynamic in the United States because there's a lot of talk about how immigration has affected GDP. And is that good or bad? And I'm not going to get into the immigration issue. But we are an aging population. And so, immigration could be a significant part of our economy, for better or worse, right? And there's a lot of arguments that immigration actually has some positive effects on our economy. But at the end of the day, yes, as people retire, they're starting to spend their money, but a lot of that wealth is going to get inherited down to younger folks. And I've not read anything, maybe it's out there, I've missed it. I'm sure that could very well be the case, that gives me any reason to be concerned about that possibility. It's just there's so much money in the market, and yes, a lot of people are retiring, but they don't spend all their money right away. And in fact, a lot of them don't spend much of their money, as it turns out, kind of interestingly. Plus, a lot of people that are retiring don't have much by way of investments. I'm sorry to say, and are living are relying a lot on Social Security. But I'll keep an eye out for papers on that. I'm sure there are some that I've no doubt missed that have done some good analysis of that question. So here's a good question. It says, from SRD, since the financial crisis, basically, stocks have been valued higher than their long-term historical averages. Why? Well, interest rates were a huge part of that. No question about it. As interest rates go down, asset values go up. That's just the way it works. Obviously, other things affect it as well. It's not just a question of rates, but that's a big part of it. Of course, interest rates have come up, as we all know, still on the lower side of history, I would say. But right now, what you've seen is, notwithstanding the rise in rates, a very strong economy. We're at or near full employment. And so, earnings of companies have been quite strong. Part of it is the tax cuts of 2017, the corporate tax cuts result in more earnings, after tax earnings. So, there's probably a lot of factors. Of course, that was, since 2017, I think, right? But to me, that those would be at least some of the reasons. I'm not an economist, but I think taxes and interest rates are a big part of it. Some will look and say, well, now it's AI and it's generating a lot of efficiencies. I'm not convinced that's true yet. Obviously, AI has had a big impact on some companies, of course. NVIDIA's an obvious example of that. But we'll see. That's my take. So Elsie wants to know my thoughts on equally weighted S&P. So just so we are all on the same page, the S&P 500 index is a cap-weighted index, which means big companies like Apple take up more of the index than smaller companies. So if you put $100 in an S&P 500 index fund, or let's just say $500, what they don't do is invest $1 into each of the 500 companies. Apple gets like $5 or more than that. We can look at it. I can show you. Here we go. So this is Vanguard's S&P 500. When we come down here, oh, Microsoft, I guess they're bigger now. So, for every $100, $7.25 goes to Microsoft stock, and 662 to Apple, and 373 to Nvidia, and on down it goes. And so that they call that a cap weighted. Cap stands for capitalization, the value of the company. You can also buy an equal weighted S&P, which does pass it out, and divides it equally among the 500 companies. The net effect of that is, and maybe it's easier to show you. So when we look at an S&P 500, we can see the blue dot here is large companies. If we put up an equal weighted fund, it would be more between the mid and large. This blue dot would come down because more money is getting invested in smaller companies, right? Because it's equally weighted. It's not given, it's not putting more into Microsoft and Apple than other companies. What I prefer to do is to have sort of a total U.S. stock market fund, which would be something, I would use VTI, but it's going to look a lot like the S&P 500. We can look at it, go to portfolio. It's not going to look much different. It's a little lower, the blue dot, but not much. And then if I want additional exposure to smaller companies, I might add a small cap fund, or you could add a mid cap fund. I just prefer to do it that way. I feel like I have more control over it than an equal weighted. And the other thing though is, I think some folks get nervous. They say, well, with a cap weighted, it's sort of dumb money and it's investing in expensive companies. And that's true, because it's just tracking the market. It's saying, look, I'm not smarter than the market. I'm just going to track the market. And in any market, there's always expensive companies. It's just the market, right? I mean, right now the top 10 happen to be companies like Microsoft, Apple, and Nvidia, but it changes, and it's going to change again. And companies 20 years ago that were in the top 10 some don't exist, and some are no longer in the top 10, and that's just the way it goes. And it'll change as the S&P 500, a fund will change as those changes occur in the market, and I'm okay with that. But again, if you want to tilt your portfolio one way or another, I just find it easier to just add the small cap fund itself, rather than going with like an equally weighted fund. But there's a lot of different recipes to get to the same kind of thing. All right. Okay. Hector wants to know if I have thoughts on using an SMA like Fidelity's tax-managed U.S. equity index strategy to optimize tax loss harvesting in a taxable brokerage account. I do, and I did a video on it, on direct indexing. I'm not a fan. For those that aren't familiar, you can put money in an account. All the SMA means is that it's going to be an account managed by Fidelity rather than by you. Rather than investing, let's say, in an S&P 500 index fund, for example, they'll invest in the actual stocks, not necessarily all 500. You don't need to invest in all 500 to do a fairly good job of tracking the S&P 500. But they might invest in 100 or more, and then they'll buy and sell to try to take advantage of potential tax losses. If Pepsi is down, they might sell it so you get that tax loss, because this is a taxable account, and go buy Coca-Cola, for example, to avoid the 30-day wash sale rule. It sounds good, but everything I've read says that the benefits, even if you've got a big lump sum of money to invest, the benefits of tax loss harvesting over time diminish, because over time you end up with just gains over time, right? At least hopefully. And then what you end up with is a portfolio with 100 or more positions in it. It's a complete mess, in my view, and you're kind of stuck paying, I think it's 40 basis points at Fidelity, I think, paying 40 basis points for the rest of your life, or having to take over this complicated portfolio, or selling it and incurring all of the tax gains that you were trying to avoid by buying into the fund in the first place. So I really think direct indexing is not ideal for the vast majority of people. There could be some exceptions for extremely wealthy people who are putting a lot of money into these kinds of funds every year, maybe, but for the most part, I'm just not a big fan. That's my take. I did a video on it. Let's see here. Direct indexing. Let's go to videos. I'm number one on Google. How exciting! In this video, we're going to take a deep dive into direct. Here it is. That's the video. So you can check that out. I published that 1 year ago. I'm standing up because my back is still not 100%, and I get stiff sitting in this chair. Oh, whew. I'm going to stand up again. So I've been at a standing desk all week. Believe it or not, my back is getting better. But man, it's still not 100%. All right. What do we got next? Do I look younger in that picture? I think I do. I've gotten so old in the last year. What is going on? What's this one? I'm still standing, so I'm going to keep the screen up. Okay, in moving to retirement, do you suggest moving your 401k from your prior company's plan to your own IRA? Well, generally, I probably. There's the rule 55. If you're 55 or older and you retire and you want to take out money from your existing 401k, you can, penalty free. So if you're doing that, you wouldn't want to roll it over. But assuming you don't have any of that going on, one advantage to rolling it over is you get to pick where you keep it, rather than what your employer has picked. But of course, maybe your employer's at a place that you like and you like the investment choices. I generally prefer an IRA. There's potentially some additional protections from liability that a 401k could provide, maybe, but I would say for a lot of folks, that's not really a key issue. Okay. So a senator here wants to know my thoughts on Fidelity Contra Fund. It's funny that you mentioned that, because I did a video, I guess it was last week, and I mentioned and looked at Fidelity Contra Fund. The distributions were substantially lower than past. I don't know about their distributions. I mean, we can look at them. Contra Fund's had a great track record. Here, I'll show everybody. Here it is. But I still don't think it outperforms an index most of the time. It's a super, large cap growth fund. If you compare it to a growth index, like we can do that. If we go to the chart and we can compare this to, I guess VUG would be a good example, maybe. If we go 5 years, over the last 5 years, VUG has outperformed. Again, we can't go to max, so we'd have to figure out, let's see, 93. We could figure that out. But in terms of distributions, you can go to performance and then distributions. In 2024, hardly any. I don't know why. But also, my question to you would be, why would we care about particularly in a taxable account, you want lower distributions, right? But a couple of things here. So most of their distributions are long-term capital gains, right? The dividend yield, I'm sure is quite small, I would think. Just 0.43, because it's a growth fund. So they're not going to pay a lot in dividends. And then one thing you could look at, let's go back a year. So if you look at last year, in February, they paid very little. No dividends, a small amount in long-term capital gains. Most of it came in December. The year before, yeah, so most of their payouts look like they come in December. Now, I admit this February it was really low. I don't have I don't have an explanation for that. I don't know why. It's a good. Well, to the extent that they're distributing short-term and long-term capital gains, yeah, I don't know why. I mean, we could guess, but I don't know why. I don't know. My favorite answer. All right. What is next? So I have 40% of my portfolio in a CD ladder. Should I count them as my bond allocation? Yeah, I generally think of it as fixed income, which would include bonds and CDs. So I would. That's how I would think about it. Yeah. I wouldn't count it as cash per se, right? I'm assuming there's some amount of penalties. I mean, if you have some CDs that are maturing this year, one might argue that should be cash. But I tend to lump cash and bonds together in my thinking anyway. Some people, mentally it's better to sort of keep cash as separate. So I suppose if you had a CD that's going to mature in the next 12 months, you could maybe think of that as cash. But otherwise, yeah, I kind of consider it as part of fixed income. So David says, I believe I heard you talk about dividends and the fact that they are irrelevant. It's a little strong, but okay. In terms of a stock or fund's value. Okay. Seriously, then, why do you choose SCHD as a value fund? Well, what value fund could I pick that doesn't pay dividends or even above average dividends, right? I mean, I don't know of any. I mean, I understand the word dividend is in the name of the fund, SCHD, but it's a value fund. I picked it because it's a value fund. I mean, all the value funds pay dividends, right? I mean, that's the whole, that's sort of the type of companies they invest in are value companies that tend to pay higher than average dividends, right? Just like growth companies tend to pay lower. So, but by the way, that's in my Roth account. So, I could care less about the dividends. I mean, that may be too strong, but it's not as if I'm investing in them because I want dividends to be paid to me so that I can then live off them in retirement, for example. They just stay in the account and get reinvested. I picked that because it's a value fund. Yeah. All right. What is next? What time is it? 8:03. Okay. Oh, this is interesting. I didn't know this. Passive 101 says Betterment changed their core portfolio away from value. That's interesting. Would you keep the old value tilted one or switch to the new one? I mean, I'm imagining both options are reasonable. If I had to pick right now, which one will do better over the next 10 years, I would pick value. Why? Because it's underperformed over the last 10 or 15 years. That would just be my guess. It's just a guess. Okay. Jim says, moving 401ks to Fidelity, thinking about moving 3 Roths to M1 Finance for a secondary custodian. Thoughts? Yeah, no reason I haven't talked about M1. I think in retirement, I really like platforms like Fidelity and Schwab because of all of the associated services that come with them. I don't think there's nothing at all wrong with M1, and I like their ability. You have the ability, particularly in a Roth, where you don't have to worry about taxes. Very easy to rebalance. I like that a lot. You're not going to get the same level of services you would with Fidelity, but maybe that's okay because you've got your 401ks at Fidelity and you can get all the services you need there. So I certainly don't think it's an unreasonable approach, but just keep in mind, Fidelity and M1, they both serve different purposes, but they're night and day in terms of technology and services. Fidelity is head and shoulders above M1 in that sense. Now, if you're 25 or 30, you're just saving for retirement, you don't need a lot of what a Fidelity or Schwab can offer, really. And the ability to rebalance very easily can be very attractive with M1 Finance. And again, you might like it with your Roth. So certainly don't have any reason to think it would be a bad decision. Boy, this is again like another SAT question. I want multiple choice. I guess you've given me 3 choices. Mimi says, for short term, 2 years or less, safe tax efficient investment, which one would you choose? Muni bond, short term T-bills, 2-year tips. Well, part of it depends on your tax bracket, state and federal, right? And whether you're also going to be able to avoid state income tax on the municipal bonds. It's just a tax question. The higher the tax bracket you'll be in, the more attractive municipal bonds are. And you can do an after-tax analysis and compare the two. As between tips and T-bills, both would be reasonable. If you're doing a short-term T-bill, you're going to have to roll it over let's say you do a 3-month T-bill, you're going to have to roll it over every 3 months. And so you're going to have rates that vary over the next 2 years. Which one would prove to be better between a short-term T-bill and 2-year tips? I have no idea. It's going to depend on inflation and interest rates, and there's no way to predict it, in my view. For short-term money, my personal choice are T-bills. But that doesn't mean that's right for you. That's just our own choice. So, Kevin, I don't know if this is a question or a statement. All 5-year rules end at 59.5. I don't believe that's true. The 5-year rule on conversions does. And if you want to make sense of that, remember the whole purpose of the 5-year rule on conversions is to prevent people from trying to get around the 10% penalty if you take your money out of a traditional IRA before 59.5. And so without that 5-year rule, what some folks could think they could do is convert the traditional to Roth, pay the taxes, got to pay that anyway, and then thinking, well, I can pull Roth contributions out anytime I want, penalty and tax-free. I can then take it out of the Roth and avoid the 10% penalty. You can't do that. But of course, once you turn 59.5, you don't have to worry about that 10% penalty. So that 5-year rule goes away. But the 5-year rule that deals with how long, deals with owning any Roth IRA account for at least 5 years, that does not go away at age 59.5. That's my understanding. Now, maybe is there a new law out that changed it? Could be. I don't know. I don't think so. But anyway, that's my understanding. Jim says he needs help with Empower. Well, I found their support helpful in the past. It may take a day or two, but that's what I would do. If you, my question, I guess, would be if you tried that. What do we got here? From Like This Guy, my wife's ex's mother taught her another saying, like as fat as a tick, which was, maybe I should have read this before I put it up on the screen. That smell would knock a hound off a gut wagon. I don't even know what that means. Well, referring to a wagon with animal. Wow. Another one my mom would say is, you're so lazy. If a hog were rooting you, you wouldn't yell suey. Something like that. I'm still not sure what that means. I grew up in Ohio. I don't know. I know it's knee high by the 4th of July. I know that. Okay. So here's an interesting question or comment from Wolfster. For note-taking and converting PDFs to articles, take a look at Google's Notebook LM. I've tried their Notebook LM. I like the concept a lot, but I'm not sure how it would help me convert PDFs to articles. What Notebook LM allows you to do is it's kind of like creating a custom GPT. You can upload up to 20 sources, and each source I think can be, it's ridiculous, like 200,000 words or something. But you could upload PDFs, for example, and then ask questions about those PDFs and take notes on them. And I like the concept a lot, and I've played with it. I haven't figured out how to incorporate it into my workflow at this point. So Doug says, I have a 90-10 allocation for retirement. Does that mean I should allocate my savings and non-retirement accounts the same? Well, if they're for retirement, right? Because you can save for retirement in a taxable account, right? So, but I guess it depends on what the savings and non-retirement accounts are for. If they're long-term for retirement, I don't see why not. Now, you may think about asset location and keep bonds in a traditional retirement account and stocks in Roths and taxable if you can, so that every individual account might not be 90-10, but when you added it all up as a whole, it would be 90-10. Hope that makes sense. I think I've done let's see if I've done a video on asset location. I have. Here we are. Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. And once again, I look younger. I don't know what's going on. This was a year ago. I don't know what I said about it. Managing asset location in early retirement. So it might be a little different than what you have in mind, but in any event, yeah, there you go. And I'm standing up again. Oh, this back is killing me. All right, what else do we have? From Sharon, is there any benefit to moving a minor custodial taxable account to a Roth IRA? I don't know that you can, Sharon. I don't know how you would do that. Right? I mean, you can convert a traditional IRA to a Roth, but you're talking about you can't convert a taxable account to a Roth. You can make contributions to a Roth, but the individual has to have earned income. So I'm not, unless, again, I could be missing something. Maybe I don't understand the question, but I'm not sure how that's possible. Whoops. I didn't mean to do that. But we'll look at this question anyway. From Christopher. What stock bond mix works well with the 4% rule? Well, let me tell you. So Bill Bengen, I can answer this question in my sleep, but let's pull up Mr. Bengen's paper. I'm pretty sure it's one that I have in my, there it is. Here it is. So this is his paper from 1994. Oh, there it is. And he looked at different stock bond allocations. And what he concluded, you can check that out on the slide. I'll just answer the question. What he concluded was that you needed somewhere between 50 and 75% in stocks and the rest in bonds. Now, for him, stocks was basically S&P 500. Bonds were intermediate term U.S. government treasuries. And that really supported the highest withdrawal rates, what he found. If you went below 50% in stocks or above 75%, you could run into trouble. Having not enough stocks was a much, much bigger issue than having too much. So like if you had to err one way or the other, you'd want to be over 75 rather than under 50. But the problem with being over 75, particularly as you get near 100, if we go through something like the stock market crash of 29, those first 3 years was down like 90%, it gets ugly. And so the sweet spot was between 50 and 75%. He ultimately concluded that, and remember, this paper was written, the intended audience for that paper was financial advisors, not consumers. Now, it's not a difficult paper to understand, But his point was, to advisors, you should get your clients as close to 75% as they can tolerate. Now, he did some additional papers later. 96 was the next one, and he looked at ratcheting down the amount of stocks by about 1.5% a year, and that could possibly be a good move, but I don't think it moved the needle a lot. But yeah, so that's what he concluded, somewhere between 50 and 75%, with sort of a bias towards being as close to 75 as possible. Keep in mind, there were a ton of assumptions in this paper, a ton. 30-year retirement. If it's longer or shorter, the initial withdrawal rate changes, right? You're not paying any investment fees, certainly no AUM fees, so no investment fees. You're using just U.S. stocks, S&P 500 for your stock allocation, intermediate term treasuries for your bonds, so no international. Now, in subsequent papers, he looked at other asset classes, but in this paper, that's what he was assuming. He was assuming that you retire on January 1st of each year that he looked at. And you may say, all right, I get that, Rob, but I mean, what if I retire on February 1st? Is it that big a deal? Well, it turns out it is. Now, is it a huge deal? No. But the safe withdrawal rate actually goes down if you analyze it on a month-by-month basis rather than a year-by-year basis. And if you think about that, it makes sense. What are the odds that the absolute worst time to retire is going to happen to fall on January retirement that begins on January 1? My point in bringing all that up is just to say there were a ton of assumptions that went into that. And since then, 30 years of research, people have challenged those assumptions, looked at different assumptions, including Bill Bengen himself. So it's just something to keep in mind. You're sorry you asked now, aren't you? Well, if you're not, I'm sure everyone else watching is sorry that you asked. One of my favorite topics. Oh, this is a good question that I may not be able to answer. Cannibalistic. What is the best resource to understand how Social Security, RMDs from an IRA, and taxes work together optimally? Well, I just did a video on that. And there's a lot of papers on it, many of which I mentioned in the video. Let me find that video for you and I'll show it to you. I forget what I called it. Was it efficient withdrawals? Must not have been. I guess I could just go to my YouTube channel and go to videos. I called it in what order. Hey everybody, welcome back to the financial. In what order should you spend down your retirement accounts? That was the video. And I looked at New Retirement, which I think is a good tool, but I also talk about some resources. And if we go to, let's see here. If we go to my research page, again, I've only got like a dozen articles up here. As you saw from Zotero, I mean, I've got a lot more. But if we go to topics and we go to withdrawal order, you'll see a number of papers. One that I like a lot is, I think it's this one, T. Rowe Price. Yeah, I thought this was a pretty good paper. And at least gives you a sense of the issues and, and on top of that, I like their colorful charts. Very bright. So you could give that a try. I think that probably give you a lot to chew on. Yeah. Okay. Keith says he put his question in multiple times. I don't know. I don't know what the question was. I must have missed it. I'm going to end the credit card rewards. It looks like the I don't care has it. Although technically you could say I should do it because you don't care whether I do it. And 40% want me to do it. So maybe that's the answer. Let me see if I can go back here and find Keith's question. Looking. Susan is very kind. You do not look younger then. It's all about haircut and facial hair. Yeah, I should probably just get rid of the beard. I don't know. Keith, I may just have to give up, or you can ask it again, but sorry. I must have gone right by it. Yeah, I don't know. I can't find it. Yeah, this is a good credit card. The 2% cash back with Fidelity goes right into your brokerage account. 2% is solid. You could do better than that, but that's really good. I don't have that card. I probably should get it. Oh, look at this. Captain Nightwatch. I have an interesting volunteer job. I'm an admission rep in the United States Naval Academy. Well, thank you for your service. Yeah, that ain't easy to get into. I've had some friends of ours have had, their kids have gotten into the Naval Academy. Ain't easy to do. That's for sure. All right. Let's see. Jeff says, I just signed up for new retirement. I plan to use a 3-fund portfolio with new retirement modeling taking from lowest percent earner. Won't it always model draining the bond fund? That's not how it works. I don't think. If I understand your question, in new retirement, you have your different accounts. Oh, I do see what you mean. Well, the way new retirement works in terms of drawdown is it'll take from your taxable accounts first. And if you have multiple taxable accounts, it'll first take from the one with the lowest assumed returns, and you set the returns for each account. So like for a checking account, maybe you've got it at 0%. So your checking account, it'll draw that down first. Of course, you probably don't have a whole lot in your checking account, relative to a retirement savings. So it's going to draw that down pretty quickly. And then it'll go to the next one. And so I guess if you had all of your bonds in one account and all of your stocks in another, and you set the percentages accordingly, with bonds having a lower expected return, and it's in the same type of account, because it goes taxable first, then traditional, then Roth, you're right. But you wouldn't have to set it up that way, right? You could have it all. Remember, in new retirement, you don't have to map your accounts one-to-one. So if you have an IRA, you could have one IRA, but represent it in 5 different accounts inside new retirement. Or you could have 5 taxable accounts. I don't know what you crazy people do. Maybe you've got 5 taxable accounts. You can model that as one account in new retirement if you wanted to, or 3 or whatever. So you have a lot of flexibility to affect the order of withdrawals. And then, of course, you can actually go in and set a specific transfer. So, for example, even though they take from taxable accounts first, if you said, well, no, this year, I don't want to take from taxable accounts. I want to take from a traditional. You can set up a transfer from the traditional account to that checking account. And so it would effectively skip the taxable accounts. The checking account's a taxable account, but I mean, your investment accounts, if that makes sense. I know it's probably easier to show you, but that would take some time. I will tell you, I plan to do another live show during the week. It won't be this week, on new retirement. The last time I did one, someone left a comment I thought was very good. I tended to cover what I think are maybe some of the more complicated scenarios in the last live stream. At least they're complicated to me. And the person made a comment and said, it would be great if you just start with a sort of a basic plan and walk through it from start to finish. Not all the fancy stuff, just the basic, how do you set it up and do a basic plan. And so I am going to do that, Jeff. Maybe that would be of interest to you. I'll give you some notice ahead of time. I don't know when it will be, but it should be in the next month. Okay. All right. Sam has a question. And I'm going to stand up again just to make sure I can. All right. Rob, first time ever commenter here. Is tax efficient investing something that low income beginners should really be stressing about? That's a great question. Well, first of all, and I'm still standing. You just have to look at me stand. Um, Definitely don't want to stress about it. The good news is it's very easy to think about tax efficient investing. So first of all, as a beginner, if you're in a retirement account, 401k, IRA, you don't have to worry about being tax efficient, right? Because it's not going to trigger taxes. Obviously, if it's a traditional account, when you take the money out, you'll pay taxes. But um, I didn't want you to see me sit down in case I fell. It's really not quite that bad, but I'll be looking forward to going up and relaxing on the couch after this, if I'm being totally honest. If you're in a retirement account, you don't have to worry about it. And in a taxable account, index funds are incredibly tax efficient. I'd probably keep bond funds out of my taxable accounts if I could, but an S&P 500 or a total U.S. stock market, very tax efficient way to invest. So it's not complicated, Sam. Here's the thing. Low income, maybe small amounts of money, you're right, maybe not a big deal now, but in a taxable account, over time, you could end up with substantial gains. I think 10, 20, 30 years from now. Now, again, if you're in a retirement account investing, it's different. You don't have to worry about the tax efficiency. But in a taxable account, given enough time, maybe making a little more income, saving more, it grows. Over time, the tax hit will surprise you. It's like a snowball, and eventually it starts a rolling. And so you don't want to totally disregard it, even when you're starting out. But again, it's not hard to do. It's not like, just a few things, and I think you're most people are probably set. All right. I'm going to scroll way down. Yes. Bullseye. I do need to get a real office chair. I'm going to go ahead and get is it Herman Miller? Do I have that right? Yeah, I'm going to get a Herman Miller chair, I think. The one I've got, but this is an uplift desk. So let's see. I'm going to raise it. It'll probably short out something. If it ends the live stream, I'll see you in 2 weeks. What? Let's see here. There we go. So yeah, so I've been standing all week. I should stand more anyway. This seems kind of weird, but I'll keep with it. No, I won't. I'll put it back down. There we go. It's a great desk. Bamboo, love it. I do back exercises every single day, Vinyl. I do the McGill 3, which are bird dogs, McGill crunches, and side planks. I do what I call alligator breathing. I don't think he calls it that, but it's basically lying on your stomach and breathing and letting your lower back sort of sink into the floor for 3 minutes, which is really good. Okay. I think we're about out of time. What else we got? Last time I will put up, and this will give me an excuse to stand back up. We did a few chess puzzles last week. And so we'll do another one or another couple. I won't do a lot because, like I said, I need to call it. So for those interested, white just moved the queen to here. So it's black's turn. Well, I must not be signed in because, I'm in check. No, I started to say, well, this is easy because I can put him in checkmate, but that would be an illegal move because I'm in check. So yeah, take a look at that. Let me look for some more questions, and you can leave in the chat what move you think I should make or we should make. Alex says Schiller P's average of the last 10 years. Why would I care? Well, the theory is that it's a more accurate assessment of the stock market's current value. If you think about just looking at 1 year's worth of earnings, that's arbitrary. Why do we pick 1 year? Why not something else? And the theory is that with 10 years, we get to see earnings over a complete economic cycle, so it's more accurate. Having said that, you can be a phenomenal investor and not care at all. So, there you go. So Ed wants me to do a video on TSP and retirement. What I might want to do, Ed, and yeah, I live here in the Washington area, so it's a big thing here. Maybe I need to find someone who actually has a TSP to interview, because I've never worked for the federal government or the military or the post office, so I don't have a TSP, never have, and I could maybe do, I guess, a lot of research and figure it all out, but it'd probably be more useful to you guys and gals if I had someone that actually knew what they were talking about, had some experience with it. So I have to think about who that might be. Well, I'll just do this one, and then we'll get to the chess puzzle since it is 8:30. Thoughts on VTSAX forever? I like it. I mean, that's the total stock market. I'm pretty sure, right? I always think in terms of ETF tickers now. I think, could you add growth or value? I mean, I have a little bit of tilt towards value. That's been my own inclination over the years. Today, my tilt towards value today is probably smaller than it's ever been because I do own SCHD, but relatively very, very small amount. So I used to get into the whole let's add emerging markets and let's do some small cap value. Nothing wrong with that approach. I followed it for 20 plus years. But at this point, I'm just very comfortable keeping it simple and just doing a simple portfolio, at least as simple as I can get it. So, all right. We have answers here. What let's see in terms of the chess puzzle. No one king to G6. So the trick is we've got mate in one, right? But we got to get out of checks. And we have nothing to hide, we got to be careful. We nowhere to hide the king. And we got to be careful about this diagonal, right? Because it might expose us to a check with the bishop. If he just moves the pawn forward, that may or may not be a serious concern. I don't know that moving to the back rank is going to help us, but we got to be careful here because if we go here and he checks us, yes, we can pull the rook back, and maybe that's to interfere with check. Where do we hide our king? That's the question. I'm going to go with king G6 because I don't have a better answer. Now what do we do? Obviously, we can pull the rook back here and attack the queen. And at that point, he has no checks. But we also don't have checkmate, and we're down a bishop. So we really got to checkmate him. We could go here. My thinking is king here, and if he checks us with the king, we'll move the pawn forward to block it. But see, that even concerns me, because he could check us here on E1 and force us here. I don't know. I'll just do whatever you guys say. King H5. That's my thinking too, but that's scary. We got to deal with we have to think about the pawn check. Of course, the queen check. Pawn check, we move here, but he can check us here and we're checkmated. So wait a minute. If we go here and he pushes the pawn, I guess we could come here. Then he pushes that pawn and checks us. I don't know. I'm nervous about king H5. I'm going to do it anyway, but I think we're going to get a red X. No, that was right. There we go. Okay. Oh, he can't check us on F1 because of the rook. That's what I was worried about, was the F or the F8 check. See, but now, yeah, we're safe. See, I wouldn't have gotten that without you guys. All right, we'll do one more, then I'm going to call it a night. You guys must like chess because there's still a lot of people watching, even though we've left the investing. Maybe I should just turn this into a chess channel. I don't know. All right. So one way to think about a puzzle like this, it's black to move, right? White's move the knight to A3. So you can go through a checklist. And the first thing is, does black have any checks? Well, 1, right? Queen to G2. This queen taking the pawn, which at first may seem like a ridiculous move, but sometimes ridiculous moves are the right moves. But that one doesn't seem very good because after the king takes it, I don't really see a follow-up. There's a rook check on D2, but the bishop's covering it. Plus, it just doesn't seem right. So that doesn't seem quite right. But one thing that catches my eye is that White's queen seems like she's in a bit of a precarious place. And I think, well, wait a minute. Can I move the bishop here? Where can the queen go? Can't take it because I'll take with the queen. Can't go here because of the pawn. Can't go here because the bishop would come back and take it. Can't go here because the knight would take it. Can't go here or here. That seems pretty good to me. Now, let's think about this. White does have a check here. But I would just drop back to D8. Oh, that's interesting, though. If I drop back to D8, White could take this bishop, attacking my queen. Of course, instead of that, I could just move the rook here to interpose the bishop, and maybe that's the answer. I think that's the answer. So that's my thinking. Does that make sense? Is anyone even still watching? I'm gonna have to check. Everyone's probably left the chat. No one's. Oh, we got bishop. Yeah, a lot of bishop G4. Okay, that's what we'll do. I bet they're gonna check. We'll see. Bishop G4. Yeah. So I think it's the rook, right? I think it's. Anyone with me? Anyone care at this point? I think we enter. Normally, you wouldn't want to block a bishop check with a rook because the bishop can take the rook, and generally a rook is more valuable than a bishop. Now, it's not always true, of course, but again, if I go back here, I can't go here, right? Because the queen. I guess I could go up, but it doesn't matter. Bishop takes, and now if I take back with the queen, I can take the bishop. If I take his queen, he takes my. I think I got interpose. Yeah, that was it. And you can analyze these on chess.com, by the way. Great tool. So we can go here and we can say, okay, if I did this, what was the answer? Yeah, sure enough, you can see here they give you a different lines, and what that was my concern was this, right? And now White's winning, actually. So tricky. All right, gang. Thanks for your patience as I have to stand up and sit down 20 times tonight's live stream. But believe it or not, the back is getting much better. Just not 100%. So as always, I had a lot of fun. Thanks for watching, and have a great week. Until next time, we should be back. Lord willing, and the creek don't rise. Let me just double check my calendar. Yeah, I should be back on the 25th. So until then, I hope you have a great couple of weeks. And until next time, remember, the best thing money can buy is a good back if money could buy it. If not, I guess it's financial freedom. See ya.